Margin trading is a trading strategy that allows investors and traders to borrow funds from a broker or exchange to increase the size of their positions beyond the amount of capital they actually own. This approach is widely used in stock markets, forex, commodities, and cryptocurrency trading because it provides the opportunity to amplify potential returns. For example, if a trader has $1,000 and uses 10x leverage, they can control a position worth $10,000. While this creates the possibility of earning significantly larger profits from relatively small price movements, it also greatly increases the risk of losses, making margin trading one of the most challenging forms of investing. Before using margin, traders must understand concepts such as leverage, initial margin, maintenance margin, liquidation, and margin calls. The initial margin is the amount of money a trader must deposit to open a leverage position, while the maintenance margin is the minimum balance required to keep the position active. If the value of the trader's account falls below this threshold because the market moves against the position, the broker or exchange may issue a margin call requiring additional funds to be deposited. If the trader fails to meet this requirement, the platform may automatically liquidate the position to recover the borrowed funds, often resulting in substantial losses. Margin trading can be used for both long and short positions. Going long means buying an asset with the expectation that its price will increase, whereas short selling involves borrowing and selling an asset in anticipation of a price decline so it can later be repurchased at a lower price for profit. This flexibility enables traders to seek opportunities in both bullish and bearish markets. Successful margin trading requires careful risk management rather than simply relying on leverage to maximize gains. Experienced traders typically use stop-loss orders, position sizing strategies, diversification, and predefined risk-to-reward ratios to limit potential losses. They also avoid committing all of their available margin to a single trade, as unexpected market volatility can quickly erase an account. In cryptocurrency markets, where price swings are often much larger than those in traditional financial markets, margin trading can be especially risky due to rapid liquidations triggered by sharp price movements. Beginners are generally advised to start with low leverage, such as 2x or 3x, until they develop a consistent trading strategy and understand market behavior. It is equally important to monitor funding rates, borrowing costs, interest charges, and trading fees because these expenses can reduce overall profitability, particularly for positions held over extended periods. Emotional discipline is another key factor in successful margin trading, as fear and greed often cause traders to over-leverage, hold losing positions too long, or close profitable trades prematurely. A well-defined trading plan, continuous market analysis, and strict adherence to risk management principles are essential for long-term success. Ultimately, margin trading is a powerful financial tool that can enhance capital efficiency and create greater profit opportunities when used responsibly, but it should never be viewed as a shortcut to wealth because the same leverage that magnifies gains can also magnify losses. Making education, patience, disciplined execution, and effective capital preservation the true foundations of sustainable trading success.